for joining me this morning.
My pleasure. Thank you for having me on the show.
So, Rhythm, the India story, India growth story is very well chronicled, that this is our time. Things are coming together in terms of what is happening domestically, in terms of administration reforms, the macro tailwinds that we have, the geopolitics, everything seems to be favoring India. At the same time, we also know that markets is not a one-way street. There are ups and downs, and corrections are part of life. Now, when you look at a long-term investor in India, I'm not saying long-term as in, I'm not specifying any time period. How do you straddle these two things? The fact that we are going to witness a long structural bull run versus the fact that you have to navigate these downturns whenever they arise. Is there a mental model you have? How do we think about it? How do we navigate in terms of strategy?
So, equity markets are for long-term investors only. Those who want to trade this are prone to losing money. So, I think that's the first thing that I would say. Indian markets have actually done quite well over time. I think the last that I checked, which was a few days ago, on a 25-year trailing basis, the MSCI India index, and this I'm using that for comparison purposes, has compounded in US dollar terms at 10%. The US stock market, which is supposed to be the mecca of investing, has done 6.2. Okay, so that's how well India has done, and I think there are reasons to believe we will continue on this path if you take a 15-20 year view. Of course, as you very rightly point out, there will be volatility along the way, and in fact, I do detect rising volatility in the coming 12 months. If not for anything, just the starting point of volatility is so low that it is bound to undergo some reversion. And of course, we have a large number of events with binary outcomes lined up. And when there are binary outcomes, the market will invariably produce more volatility. I think investors and those who come with a long-term mindset, and if you don't come with a long-term mindset, then I think there's going to be a lot of difficulty. But if you do, then I think you'll be okay in the long run, even amidst this volatility. So I wouldn't worry too much about it, but you have to structure your portfolio in order to overcome any risk of major downdrafts that could come along the way, and there will be plenty of them.
And if you were to, I don't know whether you would agree with me or not, but my understanding is the economic cycles can be very different from the market cycles. Would you agree, first of all? And secondly, if you agree, where are we in terms of economic cycle in India? There is super cycle and there is cycle, both ways. Where are we in India? And in terms of market cycle, where are we? Because markets tend to discount everything much faster today than ever in the past.
Okay, that's I think a very interesting question. So let's use a few proxies to define these things, because they are otherwise very generic terms. So let's use GDP growth to define economic cycle. And for the market, we'll have to use two variables. So one is earnings growth and the other is share prices, right? Trailing returns.
Right.
So there are three things here. So the GDP growth in India is something like this. Or I should say the progression of GDP is like this. The growth is of course up and down, but the progression of GDP is like this. When I superimpose EPS, it's something like this. So it doesn't go on a straight line. The notion that in the long run, earnings equal to GDP is correct, but that's really long term, like 50, 100 years.
Right.
In the middle of that, you could get 10, 15 years of earning cycles that deviate materially from GDP.
Right.
So if you do a logarithmic plot of India's nominal GDP and earnings, we have deviated to the downside on earnings for almost 10 years between 2010 and 2021.
Correct.
Okay, which is earnings were well below GDP trend. Now, for the last 2 years, there has been a catch-up, but we are still actually below. It is, I think, safe to say that this will now go above trend GDP and will then actually go above that and stay there and then mean revert back to trend GDP. Okay, so that is something. Now, on top of this, share prices, as you rightly point out, do even wilder swings.
Right.
Okay. In the long run, again, returns on shares do not deviate materially from nominal GDP because earnings do not deviate from nominal GDP, right?
Right.
The fact is that ultimately share prices reflect real, earnings. Not necessarily accounting earnings, but cash flows, right? So ultimately, share prices will come back to GDP trend. And if India's nominal growth over the next 10, 20 years, as I think is going to be less than what it has been for the last 30, 40 years, then it goes without saying that India's, therefore, returns on share prices will also be less than what they have been for the last 30, 40 years. So, for example, India has, in rupee terms, the Sensex has compounded at maybe around 15 or 16% over the last 43 years because the Sensex started in 1979 or 1980. Okay, and India's nominal growth has probably been around 13-14%. The likelihood is that India's nominal growth over the next 15-20 years is more likely to be 10-11%, and therefore the Sensex return will also be there. But inside this, as you rightly, there are major cycles, and they can be really long. It's not just 1 year, 2 years, 3 years. They can go along as long as 10-15 years. Now, I am of the view that, and I briefly mentioned that the earnings cycle is on its way up, and we're here to stay for a very lengthy period, and it's probably going to go above trend GDP.
Okay.
And therefore, share prices will follow suit or will lead that. As you again rightly pointed out, they will lead the earnings cycle. The market will discount the earnings. So the likelihood is that share prices will also materially deviate from the economic cycle to the upside as this bull market progresses. And why is that happening? So that I think is critical because the explanation is far more important than the view, by the way.
Correct.
Okay?
Correct.
I go wrong very often. So let me caution everybody on that.
Right.
But the explanation is something you can test me on. So the explanation is as follows. There are 3 things that have happened, I think, which are noteworthy. So first is that we've had macro stability like never before. Now this macro stability has been earned from hawkishness on inflation. So we've as a country changed our approach to inflation.
Yeah.
If you go to prior to 2015, before the law was etched that the RBI's sole mandate is inflation, in the past we've oscillated between growth and inflation as an objective for the central bank depending on the mood of the day.
Correct.
Now that has not augured well for macro stability. And to just simplify, macro stability is our dependence on the world to grow. Okay, that dependence comes from 2 things: the trade that we do with the world and the capital that we eat from the world. Okay, and that has changed materially in the last 8-9 years. We're no longer dependent on global capital markets to fund our growth, and we are trading in a very different way from the rest of the world, which is our terms of trade have evolved, and we are now less susceptible to adverse movements around the world, especially in oil. The oil intensity of this economy has gone down because of 2 reasons: GST, and I'll explain that in a moment. And also because of the ubiquitous availability of electricity. So a lot of long-term market participants will know that 15-20 years ago, diesel genset companies used to be toast of town. Because every home in India needed to have a diesel genset or an inverter
as a backup,
because electricity was not reliable.
Correct.
That has changed. Every single of India's 600,000 villages has electricity now. So our consumption of diesel as a primary source to generate electricity has declined, and therefore our consumption of oil. The other thing that happened about 6 years ago is...
How significant is that? I mean, what is the quantum?
I'll come to that.
Okay.
I'll come to that. Let me finish the second point and then we'll talk. The second thing that has happened is GST. What has GST done? It has eradicated interstate borders. Prior to 2017, trucks would line up for hours outside state borders to pay the toll tax, to pay the interstate tax, to pay all the taxes, right? corruption aside, it just basically involved a lot of fuel consumption. Trucks
Right.
used to move a lot more slowly on our roads. Even cars that passed through toll nakas had to line up for hours, right? Because we did not have electronic toll nakas. That's changed. Under GST now, no interstate tax. So people just move RFID. You get checked out, and the entire wait time now has crashed, right? Likewise, so the amount of time that we are spending on the road has reduced. Therefore, the amount of fuel that we're consuming has reduced. So if you look at the oil intensity of India's economy, it has declined sharply in the last 15 years. So 15 years ago, when we were a $1 trillion economy, we were consuming 100 million barrels of oil. Today, we're doing 157, 160 million barrels. We're nearing up to 4 trillion. So that's your number. We've quadrupled as an economy. Our net oil consumption is up 60%. The terms of trade have changed. We're exporting a lot more services to the world. In the last 3 years, our services exports on a net basis have doubled. Our market share in physical goods exports has improved. So essentially, macro stability has improved.
Right.
And the most critical thing is that we're no longer dependent on global capital markets to fund that saving deficit that we have.
Right.
Okay, that dependence meant that we were a lot more sensitive to what the Fed did, to what US growth did, to what oil did. Why? Because these capital flows were sensitive. Now, since a large part of our deficit is funded by FDI, which is less sensitive, at the stock market level, the correlation with oil, with Fed funds rate, and with US growth has crashed. So we used to be negatively correlated with oil, no longer the case. You couldn't imagine what the RBI has done in the last 2 years. In 2013, Ben Bernanke just said taper. And Indian markets, currency, everything was down significantly. We have comfortably stayed behind the Fed in this cycle without any repercussions. And this is essentially because of macro stability. So that's the first change. The second is the focus on profits. I think this administration announced that in 2019 when they cut corporate tax rates. And essentially, we are in this economic model where we are trying to boost corporate profits because that will lead to higher investments and more jobs and a virtuous economic cycle. It's a more reliable way to generate growth than to undertake social spending and consumption. Okay? And the third thing is this shift that happened in 2015 when we allowed retirement funds to invest in stocks. It's very similar to what President Reagan had done in 1980 when he allowed 401k plans in America to invest in stocks.
Right.
And what you got then was a subsequent 20-year bull market which only ended with the NASDAQ bubble.
Correct.
When the index traded at 100 times earnings.
Right.
We're nowhere close to that.
Right.
And because our demographics are different, I think this is not a 20-year story for India. This could be a 40-year story.
Right.
So the bull market is underpinned, and I'm simplifying this. There are other things that are happening. For example, in consumption, we've just arrived at the sweet spot of $2,500.
Yeah.
Where a lot of staple consumption peaks out and discretionary consumption takes off.
Right.
We have an unmatched digital infrastructure, which is allowing the government to undertake social transfers, which has made it cheap which has made it possible for banks to open accounts to the hitherto unbanked who were not commercially viable.
Right.
So suddenly financial penetration is way above our per capita income. At the current per capita income we have, the amount of financial penetration we have achieved is unparalleled in world history. So a lot of these things have happened, and that underpins the economic cycle, which looks very good. There are risks. I know you would have asked that. The risk is global because the world is not as good as it used to be. It's heavily indebted and is slowing down, and it's also aging. Okay, so this is no longer a 5% global growth environment, is more like a 3.
Correct.
So we do have that headwind because as we try to trade more with a slowing world, we'll rely on acquiring market share to ensure that our terms of trade remain intact. I think we will acquire market share. We'll more likely double our market share in the next few years across the board, but that's one headwind. The other headwind is, our own political cycles. They keep coming and going, and any change in administration brings with it some uncertainty, volatility, some setback in investments. So we have to keep an eye on that. Geopolitics, I think, again, continues to feed its pushes and pulls. I think our farm sector requires reforms. That's another headwind that we run into. So there are a few impediments, but I think, generally speaking, our economic cycle should be okay. Our earnings cycle, I think, is on its way up. Companies will gain share in profits. We peaked at 7% in 2010, went all the way down to 2 just after COVID broke out.
Yeah.
We're now back to 5. I reckon in this cycle we'll go past our previous peak. By the way, the US at its peak 12 months ago was at 13. So share of profits in GDP is 13%. This determines how profits are linked to GDP.
Right.
So we gain share. How do we gain share? Profits gain share when the investment cycle happens. Because the main anchor to earnings is investments.
Right.
And I think we're starting at a low point. You mentioned at the outset, we're starting at a low point on investments,
Right.
low point on corporate leverage. So this is a good setup for earnings to gain share in GDP. So earnings, I think, will trend better than GDP. And therefore, share prices will actually do a whole lot better. And then, of course, the question arises on the headline multiples. I think they're okay. They're not exuberant. Of course, they're not cheap. But the thing I recently wrote, and I tell this to investors, if India gets cheap, you're not going to buy it.
Why is that?
Because it will only get cheap in a crisis. And everybody will run away. So the problem about this desiring that, only if stock multiples got a little lower, I think that's getting a little too cute about this. Can they fall 5, 15, 20%? Of course they can.
Correct.
Are they going to fall 50%? Well, they can, but that will be a crisis. You will not buy stocks then.
Right, right.
Because then fear will grip the world and people will say, this is not a place I'm coming to.
Correct.
So I think the market keeps giving 10% corrections.
Yeah.
Right? And everybody bids into those corrections. So you keep getting those corrections and they will keep happening. You could get even a longer correction. You could get a deeper correction. And some of these events may go against us. Say, for example, in 24, and the corrections could get deeper. But I don't think it upsets the overall dynamics of a long-term cycle that we are in. And what underpins this, ultimately is demographics. Which is we have a young population that is highly aspirant.
Right.
Okay, that wants to win. And it's a force that's very, very difficult to counter.
Correct.
I think people should not, even for a moment, underappreciate how much the rising lower middle income group wants to succeed.
Correct.
And that's our driving force.
Absolutely.
And that is not an advantage almost any other country in the world can claim.
No, absolutely, absolutely spot on. So what I take away from this bit that you have said is that market is actually catching up or making good the underperformance over the last few years, and therefore, as the earnings grows from here on, market share prices will also tend to go up in tandem.
Earnings are playing that catch up. In large part, that catch up is done now. There's still a little bit of gap left. I think it will be covered this subsequent 12 months. And then earnings will start its ride to go above trend.
Sure.
Because that's what it usually does.
Sure.
And of course, I have reasons to believe that because investments drive that, terms of trade drive it. And those are factors that favor earnings right now. So that it will go above trend. Prices prices anticipate that. Not all that. I mean, the market is not oblivious to this.
Right.
That we are in a new earnings cycle, which is taking earnings a whole lot
Correct.
higher.
Correct.
It's not stupid. The market collectively is very smart, but it is unlikely that it's fully priced in. So there's still room for this to surprise us on the upside.
Okay, so there is just this one statistic that we did a study on, which essentially just did an implied growth for all the Nifty 50 companies. It's a simple estimate from Bloomberg. And more than 65% of the Nifty 50 companies showed implied growth of more than 15%. So my question to you is, if we are assuming a nominal GDP growth of, say, 12%, 13%, 4% inflation, 8% growth sort of a scenario, what does it tell you about markets when 65% of the market is assuming a 15% growth rate in future?
And what is the other 35%?
So that is all in the range of 10 to 15%.
So that will, I mean, I don't know the math in your calculation. My calculations will be slightly different. But anyway, keeping that aside, that is okay. I mean, as I said, it's not like the markets are exuberant or are deeply undervalued. They seem to be in the ballpark. 15% is not a very high number. It is fairly achievable where we are in the earning cycle right now. Of course, as I said, there are risks to this.
Right.
Keeping those in mind, I think 15% should be a pretty good base case scenario. In fact, I would opine that on a 3-4
could
year
surprise.
basis, I think broad market earnings could compound at 20%.
Okay.
I mean, you can do that math. If the share of profits rise from 5 to 8 and nominal GDP is doing 10, 11,
Right.
you'll arrive at a 20% number.
Right.
And if that happens over 4 years, you get 20%. If it happens over 3 years, you get a faster growth. So the question that you should be asking is, why is the earnings share in GDP going from 5 to 8?
Correct. I'm
So
just
that fundamental is underpinned by the investment cycle. So earnings are a function of 5 variables. Okay, it's what investment is happening in the economy, because that creates earnings. Earnings come from investments. How much the government is dissaving, that contributes to earning, which is the deficit. So if the deficit is declining, it's a drag on earnings. By the way, my base case is the deficit will decline in the next 3 years. So there's a slight drag, not a very big drag, but there's a slight drag. How much households are saving? A household save, it's a drag because it's lesser consumption.
Yeah.
That is a very positive contributor right now, because even though gross savings are pretty much in line with history, I think much has been written about the net saving number,
Yeah.
but really it's the gross saving number that matters. But because households are leveraging, and this goes down to the comment I made about the aspirations of
Yeah.
the middle and lower middle class, is they are willing to spend their future.
Correct.
It'll end badly in 20, 30 years, but not today.
Right.
Okay? And therefore, that brings forward the earnings.
Right.
The third is the trade deficit, or the current account deficit, to be more precise. A deficit means you're losing production to companies outside India. Okay? So that deficit is declining on a structural basis, as I explained why. Because we are importing less oil, we are trading
Correct.
more with the world, and the trade is in our favor.
Correct.
So that is a positive contributor. And the final thing, which will surprise you, is the amount of dividends that companies pay. Dividends that companies pay go back into the economy as consumption. Okay, so when they are rising, it's good for profits, ironically. Okay, but that is how it is. Now, of course, when they are rising, it drags down the investment rate, because that's lesser saving that the company is doing. And therefore, to compensate that, companies can leverage. And as I said, the starting point of leverage is low, so there's room for all these things to grow.
Right.
All these 5 drivers, except for government dissaving, which I think will reduce, are all very positive for earnings. This is where earnings come from. Ultimately, earnings don't come from revenues and margins. They come from the investment rate, government dissaving,
Right.
household saving, trade, current account deficit, and dividends.
Right.
So when you fundamentally comprehend that, and of course, people may have different views about these things and you can argue about it, but the explanation is this. And now you can form your view around this. But once you intrinsically understand where earnings come from, I find it difficult to opine that earnings are going to lose share. My base case is earnings will gain share.
Fair
So
enough.
that if we are in that cycle, then I think we're good for share prices until that peaks, or the peak is getting apparent, because share prices will peak 12 months before that.
In terms of 3 or 4 things that are most important for markets to watch, or markets will react to next year, what will be your order of priority?
Okay, so of course elections, that I think is the most critical event. We have to keep watching oil prices. The oil price is above $110, $120, I think could hurt. Until then, I think we're okay. We need to watch the Fed, because if the Fed decides that it's time to cut rates, and our US economist believes that's a June event next year, I think it will set the stage for the RBI to get less hawkish. Until then, I think the RBI's tendency will not to be preempting the Fed. But again, it will be inflation data dependent, and therefore inflation dynamic also plays a role here. So we keep a watch on that. I think earnings in large part will do quite okay. So that will not be a headwind or tailwind. It will be a slight tailwind for the market, but not a headwind. We need to watch for the US growth cycle. Again, our base case is that the US will soft land. That's something that's happened often in the last 100 years. So it's quite a unique outcome. And if the US does soft land, I think it sets us up quite well. As you know, I think India will do very well in that situation. So I think you keep an eye on that. I think you keep an eye on China. Because if Chinese growth comes back, it will have its pushes and pulls on commodity prices, on export pricing. So there are a lot of moving parts to China's outcome in the short run. And China is pressing policy hard to revive its economy. So we have to see how successful it gets there. Yeah, there are a lot of imponderables. I mean, I just highlighted a few of them. We could go on and on.
Sure.
As you said at the outset, there is always a wall of worry.
Absolutely.
And until the time we feel that there is a wall of worry, the markets have not peaked.
Correct.
It's when nobody thinks that there is
any worry. Everybody is on the other side.
Yeah. So far as there are so many worries, I think we're okay.
Absolutely. Thank you so much, Rhythm. Such a wonderful pleasure talking to you. Thank you so much.